That's what.
Yeah, I guess we'll go ahead and get started. Welcome everyone. Excited to see all the bright and cheery faces. Today we're hosting Nick Hollifield, who's a business development manager at Republic Bank. We've done a deal with him in the past. Actually, Nick Grisanti and I did a deal with him. He's great, very responsive and very competent in what he does. So I wanted him to come by and kind of talk about the commercial financing process. The way I was thinking about structuring this meeting is to kind of keep it pretty high level. We have variety of different types of people. Some are business owners, some are newer investors, some are experienced investors. So if we can keep it relatively high level as far as the nitty gritty of what commercial financing is. But what I thought we'd do is just start off with maybe a few questions. I have a few that I've written. I was just going to open it up to the general populace to see if there was any other things you want to know in particular, and if they have any others after the meeting, they could just reach out to you.
No, I'd love to feel it that way. Just Q&A, keep it going. I'd love that. That would be best, I think. So, yeah, go ahead. What you got?
Yeah. So starting out, I kind of wanted people to know a little bit more about you. So if you wanted to talk a little bit about yourself and why'd you get into banking, in particular the commercial side?
Yeah. No, it's a good question. So, I was working at Jersey Mike's one day, and we had this was back in 2011. And one of the employees there said, "Hey, I'm gonna go work at a bank. I want to make more money than this." I was like, "Well, I want to make more money too." So, at the time I applied for a part-time teller position. I didn't know what I wanted to do with my career. I had no idea. It kind of fell into place. And I found I was really good with, communicating with people. It was more fun than actually doing the transactions themselves. I hated that part. I wasn't a huge fan. And then 2 years later, I went into a personal banking position. I handled consumer lending. I did some lines of credit, started touching the residential side of mortgages and things like that. In 2014. So, and then in 2016, I had an opportunity, and somebody I think for me actually even being here is a gentleman named Tim Cleary. Many thanks to him. He was my first commercial property that I did. It was a small single family, really. But I fell in love with the process, the ability to make money, passive income. And I was like, wow, that's awesome. I want to be a part of this more so. And then 2017, it's really what I started focusing on. I developed a pretty high portfolio, and then my wife told me she wanted to move to Colorado, be with her family. I jumped on board. We're young. Why not give it a shot? I did business banking out there. I handled like equipment finance, manufacturing lines of credit, small treasury, things like that. And then we decided we wanted to move back home, and I came back, and about 95% of what I do now is commercial lending. So since about 2016, I've really focused on the commercial side because it's what I'm really passionate about.
That's awesome. Yeah, I mean, you're great at what you do, so I really appreciate you kind of sharing that information with us. So from a commercial standpoint, there's really two types of people, right? There's the business owners who are looking to finance their building, whether that's retail, industrial, any type of commercial type building. And then there's the investor side of things, which they're really interested in trying to purchase investment property for cash flow. So what I thought we would do is we talk first about the small business owner side of things, just because there are some small business owners in the audience, and I kind of wanted to provide them with some information about the opportunities out there for small business owners. And then we could touch on the investor side of things, because I would say the majority of people that I've interacted with over the last year have definitely been investors. And I know a lot of them are interested in the commercial side of things, but they just don't know a lot about it. So I thought we could touch on that as well. So if you want to, I kind of wanted to ask you, for small business owners out there, what are the best ways to kind of finance a property if they're interested in purchasing a commercial building?
Yeah, that's a good question. So the cool thing about owner-occupied buildings is that you actually have more options than you would if you were just looking for investment property. You can partner with the SBA, and that's a scary word, and we'll bring that up here in a minute too. But and then as far as buying that property, banks, this is my opinion, of course, I don't speak for my bank, but from past deals that I've done with this bank and with previous bank, owner-occupied property, you can stretch a little bit more. And the reason I say that is if you're in a pinch, you're in a bad situation, are you going to let go of investment property, or are you going to let go of something that is your mainstream line of income, right? So, I mean, when we see owner occupied, we kind of like, get our eyes open pretty big because we know, hey, underwriting's going to stretch a little differently here than they would if it was just a piece of investment property. So as far as, obtaining owner occupied property, right now times are a little different, obviously, but when you're investment property, the idea is 20% down, right? I mean, that's kind of the go-to number right there. Well, every circumstance is different. I'm not saying that it happens like this every time, but sometimes it's a little different when you come to owner occupied. You may not need as much liquidity because we understand you're doing this to improve your cash flow situation. Let's say if you're renting a property, I just had a deal where a gentleman was paying $5,000 a month for a manufacturing facility. Well, we financed his building, and now he's paying $3,500, and he's leasing out a small portion of that for $1,000 a month. So now this guy went from 5,000, to 1,500, whatever that was. So it was things like that. Really, I mean, that's what gets the bank churning and saying, hey, we're going to have an owner occupied guy. He banks with us already. That's another huge piece of relationship, and saying, hey, we're gonna give this guy a way better situation. Hopefully that elevates where his business goes and what we can do with him.
Yeah, for sure. Would you say that if you do have an established relationship with the bank itself, there's generally more wiggle room as it pertains to financing terms and everything else?
Definitely. And to answer your question around and to kind of, high level that is, a lot of people look at a bank and say, oh, well, you're charging me 4.5%. The bank's making 4.5%. And that makes them laugh every time somebody says that. And I'm like, no, that's not how it works. A bank has a cost of funds. We have to borrow off treasury. We borrow from investors. There's things way high level beyond that are going on. And you got to pay employees. We're not borrowing money at 0% right now, right? So when a bank goes out and gets its money, let's call it a 2% cost of funds, and we charge you 4%, we're making 2% on that money. So the idea that, we're making 4%, it's a silly idea in my opinion, but ultimately relationship helps that quite a bit. So let's say you have a gentleman coming in, bringing in $100,000 deposit relationship. Well, those costs of funds are very low, right? I mean, those are operating costs. I mean, you bring it into a checking account that pays maybe a small amount of interest, but it's for operating expenses for the operating company. And then they want to get a $200,000 loan. Well, we don't have to go out and borrow from the feds for those funds. So, a person who brings in a relationship, that actually really helps the bank quite a bit. So a relationship is key here. Leveraging that, if you're with someone else and trying to get to a bank, that's a really key part in trying to go. That's almost a negotiation piece with a bank is, hey, I'm going to bring my relationship to you.
Sure. And then you did kind of touch on a point that I thought was pretty interesting, and that's something that I've kind of explored as far as being a potential opportunity for business owners is the SBA program. And you could probably touch on this a little bit more than me, but let's say you're a business owner that is looking to secure a building. The SBA requires you to occupy 51% of the space in order to qualify for an SBA loan. So if you buy a property and then occupy at least 51% of the space and lease out the rest, you kind of perform what's known as a house hack. It's similar to what you have in residential real estate, where you essentially buy a property, rent out some of the spaces, and use some of the cash flow to pay off your mortgage. And I'm sure do you account for that in underwriting as well, or how does that function?
Yes. Yeah, we do. We do account for it. Now, the SBA may not.
Okay.
Because now know that this is another piece, is that we as a bank are an SBA approved bank. So we can do a lot of the footwork. Now, it still goes to the SBA for their seal of approval, and they're not going to really care about that as much as we would maybe. But it is considered. Yes, it is considered. And as far as the scary words surrounding the SBA, I really would love to talk about that for a minute because,
Sure.
I'd say SBA and people think, oh, fees. And I'm like, well, I took a guy and did an SBA loan where he was paying $5,000 a month. And that was, again, we did an SBA loan on that. Well, he's saving $1,500 a month by acquiring the building. The reason we went SBA is because he didn't have a large amount of liquidity. And that's another thing with the SBA. A lot of times you can do a 504 loan and you only have to put, maybe 10% down, or, 7A, 15% down. If you're able to hold on to cash for operating, cash is king, right? So, if you're able to hold on to those monies, then, you're going to have a way better outlook than if you just kind of threw out everything. Because he had the opportunity to put down 20%, but I was like, you need to keep your cash. And the fee to do that SBA loan was like an extra $2,000. It wasn't ridiculously different.
In order to save that much on a mortgage payment too, that's pretty awesome. So as far as the common pitfalls you see business owners encounter when they try to pursue a loan, do you want to provide some feedback as far as that is concerned?
Yeah, a lot of times, and it's actually twofold with investors as well. A lot of times they get too speculative. They say, oh, if I do this, this will happen. I want to be more realistic. That's number one. Number two is, this is a big one, it's a silly mistake, is a lot of times borrowers don't want to list all their assets because they're scared all the banks going to take all my assets. I'm like, well, we want to be covered. We're not in the business of owning real estate, but if we ever were, we want to make sure we get our collateral. But that's that everyone understands that. But no, people don't list all their assets. They don't list their debts. They don't have the real conversation surrounding that. They just kind of assume the bank's going to know what it means and what it is. That's one thing. The next thing, and a lot of times I make my borrowers do this, is, why is this good for you? I always ask them, why is this good for you, and why is this good for me? Because we're a for-profit company. We're here to make money. And I know you're here to make money, but we need to understand why this is the way it is. So, making sure that that's understood going into a deal is very important. And especially, again, if it's ever speculative, then it really needs to be understood why this is a good deal and why it makes sense. So that's one mistake. Liquidity, speculation are two big no-nos. I mean, have your ideas ready and make sure that they are solid and concrete rather than speculative.
For sure. Cool. Awesome. Well, that's great on the business owner side. So let's switch gears slightly to the investor side. So I know plenty of people out there that are residential investors, but they want to branch into the commercial space, whether that's investing in shopping centers, multifamily, even industrial properties. They're performing very well in this environment, and there are opportunities out there to purchase those type of assets, but
right,
they just don't really understand the whole process as it pertains to securing a commercial loan. I mean, it's much different than a residential property. So I thought maybe if you could talk a little bit about that process, that would be helpful as well.
No, that's a great, I love to talk about that. So nailing down the process and nailing it on the head. So up front, I ask for financials. I give people a package. One of the things, the common mistakes that happens is someone misses a document, and I have to go back to them, or it's missed by me. They send me a huge package. I missed one thing, send it to a processing group, and that can delay things. So, being up front, checking off a box when a lender gives you a checklist of items saying, "Hey, I need this, 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 and this." That's huge. So that's one of the biggest common mistakes we have is there's missing documentation on the front end. A completed PFS, a PFS that has every asset liability on there, because
just for people who don't know, PFS is personal financial statement.
Sorry. So a personal financial statement. Make sure that thing is detailed, and explain, like, if there was, for instance, like, unless it's like a medical collection, let's say you had a collection a year and a half ago and it was just a unique circumstance, make sure that's noted. And when you tell the lender that information, because the underwriter is going to look at it, and if there's nothing explained there, hey, my mom was in the hospital, I was taking care of her for a month and a half, I completely forgot about it. Something like that it's a one-off, right? It's not indicative of what kind of borrower you are. But if an underwriter sees it and you don't have an explanation, then you're just that's just a negative factor for you. So that's important. So as soon as I put a loan into my advisor queue, that's what we use, software called Advisor. We submit that to our processing group, and within 48 hours, it gets checked, and sometimes sooner, 24 hours, depending on how the volume looks. Within 24 to 48 hours, we have somebody check for the documentation, say, hey, yes, we have everything we think we need. Once that happens, it goes to our credit group. And within usually within 5 days, we have an analyst write up, given that we have everything we need. So, within, I'd say 7 to 10 days, you have an underwriter's evaluation from when you submit a loan to when or until the credit makes their decision on there. And a lot of times credit will make a decision saying, hey, look, we'll do it this way. We want more, we want more money down. We want more assets. We want an additional borrower. Things like that come up. But let's say we get an approval on day 10. Okay, I go to my client and I say, we've recommended your deal. And maybe a couple days after, depending on how busy they are again, we say, hey, we recommend this deal. We'd like to collect your upfront money so we can order appraisal and title. Those are two things. On the commercial end, unlike the residential side, a lot of times the mortgage company or bank will order the appraisal and title up front, and then check whether or not you're approved, excuse me. So obviously appraisal and title ordered at that point once we collect those funds. As far as that process, I've seen appraisals take 2 weeks. I've seen appraisals take 4 weeks. It depends on how busy they are, how busy the vendors are. Right now, if we ordered an appraisal, probably not too busy. And so you kind of have that about 5-week gap to say, hey, it's smooth, we get our appraisal back. Once an appraisal comes back on a commercial property, within 2 days, it has to be reviewed by our appraisal group. And in that 2 days, what they're checking for is to make sure the appraisal was written up properly. We've had scenarios where there's parcels that were missing that were a part of the deal. That it happens rarely, but it does happen. But they check to make sure everything's there. And then from there, if we've got all the documentation we need, we've got the appraisal, we're setting up a closing. Now, that's on a big commercial property. That's going to be your, those multiplexes. It's not going to be your single family homes. So single family homes are obviously a lot. Those don't take as long. But when you have huge commercial properties like that, that takes a little bit longer. But when we see a property like that, 4 to 6 weeks, that's my safe number. We can get them done sooner, but a lot of it is dependent on third parties. And a lot of people don't understand that. They're just like, where's the appraisal? And I'm like, well, I don't get to go evaluate your property. We have to pay somebody to go do that. So that's a common, hey, what's going on with the deal? Wait on the appraisal. I'm sure you've heard that one 100 times.
Yeah, definitely. And then as far as the underwriting process goes, because you did mention it briefly throughout that whole explanation, is that one of the misconceptions I often hear, which is not necessarily a misconception, but it's something that people put a lot of weight on, is they say that as long as the building produces enough income, then we're good to go. But in reality, the underwriting process is a holistic process. You take into consideration a lot of different avenues. So maybe if you can touch on some of those, because obviously that's a big deal. Obviously, the debt service coverage ratio is one of the things that you guys look at. But I mean, that's something maybe you could talk a little bit about. Yeah.
So no, that's a good question. We don't look at that. That's another speculative thing, right? Let's say you go buy a property and you're at 90% occupancy. Okay, well, yeah, it's still cash flows at 90% occupancy, great. But is it possible that you could be at 70% occupancy, especially when it comes to commercial use space, right? I mean, like if you have retail space, there's no higher turnover rate than retail space, right? So, or as far as it goes, like as far as vacancies go, excuse me. So, it may take a long time to fill that space. So maybe you're not cash flowing for 6 months, or maybe you're cash flowing even for 6 months. Well, we're here to get you into a place that can be. But the underwriter is going to look at vacancies, and they're going to do vacancy rates, and they're going to underwrite cash flow based on vacancy rates as well. What kind of, I guess you could say, counteracts that is going to be global debt service. And global debt service is all of your personal income and your personal debt added with the building that you're acquiring, or any other rental pieces that you have. So if you have a building that says, hey Nick, it's 70% occupancy, I'm at a 1 debt service, I'm servicing my debt every month, that's how it's going. Well, what's your global debt service look like? That's going to help mitigate that in some ways. And a lot of people don't understand that either. Is they think, hey, this has to cash flow specifically. If you have a property, this is one of those speculative times where I think it would be okay if it was explained is, hey, I've got a property that I can buy that has 8 units. There's 4 units covered. It only has 4 because there's been work on the other 4 units. Yeah, but I want to buy this property now. I'm going to get people in here within 24 months. Well, how's your global debt service look over those next 3 months while you try to get that stabilized? So there's reasons for speculation, but for the most part, debt service and global debt service are going to be highly looked at.
And then as far as global debt service goes, that's another thing we kind of touch on, is that there are some investors that are interested in getting into this space, but they may not immediately have a large income. So
Right.
Would you agree teaming up with someone who may be able to kind of act as that guarantor as far as they're
Right.
be able to kind of have that holistic
Yeah.
approach that pertains to underwriting?
Definitely. No, I think that's great. If you know somebody who is maybe not seasoned, but maybe newer to investing, and they've done it maybe a couple times, teaming up with somebody like that's always a great idea. Another thing I always say, and you've probably seen this happen a few times too, a lot of people want to start with single family property before they get into commercial. They really want to understand what that's like. And the cool thing about that is you can go secondary market on investment properties. I think it's up to 6 properties now. I haven't kept up with the secondary market side, but I think you can invest up to 6 properties in your personal name through the secondary market, and you can finance those out for 30 years. So whereas the commercial side, you're looking at about 20 to 25 almost every time. So that's another great way to go. And we handle that here too, is looking through the secondary market rather than just jumping straight into an LLC commercial, side, just get a taste of what that looks like.
Great. Well, I think those questions are, those answers were awesome. I just kind of wanted now to talk a little bit about the current situation. I know that, we've talked a few times about what's going on with COVID-19 and how that's affecting how banks are approaching different underwriting. And so I was just kind of wondering if you could talk a little bit about what's currently happening in the commercial banking side, and then maybe what you foresee in the next 6 to 12 months.
Yeah. So as far as lending right now, our box is tight, and I think that's across the board. That's to no surprise. Right now the new norm. Almost every time 20-25% down right now. We're not fixing rates in right now for too long. Rates are fixed in right now on the commercial side at 5 years. We're sticking right now today, I think, I'm at 4% on the commercial side. And the reason that is, and the reason they're keeping that they're keeping that really strict, is because the Treasury is bouncing all over the place. If you look at the 10-year Treasury over the past, 4 weeks, it's crazy how much it's jumped back and forth with how legislation's been passed. And, there's a lot of optimism one day, and then the next day there's not so much. So that really kind of affects how we're going to, how we're going to price things out. But right now, 5/1 ARM, over 20 years, 20% down. That's going to be across the board right now, I think.
And then as far as the next 6 months or 12 months, do you think you foresee some changes? It's really, it's also all up in the air, but as far as...
definitely. No, it's just my opinion, right? I think that, I don't see spiking rates over the next 12 months. I see rates staying in around that 4% margin, maybe lower in some scenarios, but, as long as prime's staying low, as long as the Treasury's staying low, I don't see rates climbing too much. What I think is what we'll see appetites open up for longer fixed rate periods and we'll probably see that over the next 3 to 6 months. So banks will get a little more creative on what they're offering as far as fixed rate periods as well as rates. But once everything starts opening up and there is real optimism and, let's say restaurants are going well, let's say manufacturing picks back up. That's one thing to really looking at is the manufacturing GDP. But, I think that we really will, over the next 3 to 6, rather than just 12, see some optimism, see more approval, see more of an appetite for borrowing bases. I'm pretty confident we'll be back, not to where we were, I'd say 12 months ago, but, maybe 50 to 60% of what we were looking at 12 months ago.
Awesome. Well, hey, that's really all the questions I had as far as the pre-prepared ones. But if you guys have any questions in particular for Nick, I'm sure he'd be happy to answer.
Definitely.
And what we could do is if you could type them in the chat box just so we can kind of keep coordinated.
Let me take a look here. Let me see if I can pull up the chat box here. Let's see here. You have the chat box pulled up, Raphael?
Yeah, I have the chat box. I can read it off if anyone has any questions in particular. Let me see. I'll go on Facebook real quick to see as well. Let's see. As far as underwriting.
One thing I'll mention while you're looking that up is, the interesting thing, the thing I think I love most about the commercial lending side is every deal I do is different. And with the mortgage and consumer side, it was the same thing. It's what are we looking for? It's the same thing every time. Whereas commercial lending is, it's so unique, man. And that's why I love it so much. Is it's a different challenge every time I get something new.
Yeah, for sure. Yeah, we did a deal recently, well, in December with a retail investment, and I'm sure you deal with industrial. And what are some of the ones you've seen a lot of, at least recently?
Believe it or not, it's been weird. I've been seeing more owner-occupied property, people wanting to buy their buildings more so recently, which is actually, again, like I spoke on earlier, I love when owner-occupied comes in because I know the bank's going to be a little more creative. I've got extra options with an SBA loan, and I love that side. So, and the cool thing about that is you have a lot more to leverage as a business owner. Generally speaking, you have a lot more leverage to offer as an operating account. You're going to have merchant processing. There's revenue. Bank's going to look at the revenue streams and say, hey, I've got a revenue stream there. I'm going to have debit card transactions, or I'm going to have ACH. They're going to say, hey, look, I've got revenue streams elsewhere other than just this loan. And so if that's the case, what happens is you have a situation where you have a client being brought in that lowers the bank's cost of funds because they're going to pay, they're going to pay, you call it fees, but it's a service really at the end of the day. Mm-hmm. You're going to offer services. You're going to have low cost deposits, and that translates into a good opportunity to acquire a loan. So that's what I've been seeing most of. I saw a manufacturing facility. I did one, and shout out to TrueFit Auto Glass. They're gonna take down. I think they're gonna take down Safe Light's business. I'll tell Matt Morrison that I gave him a shout out here. But we got to work with him on acquiring his building, which would allow him to do even more revenue. That was really cool. That was an auto glass body shop we got to work with. Trying to think, who else did we work with? We got to do a dental group in Bardstown Road. We got to do construction, which that one was really cool. I don't know that we see too much construction over the next 12 months. Yeah. And then
that kind of plays to this question that we just asked. What's the appetite right now for value add or construction type projects as far as that you've seen over the last couple months or so?
Yeah, no, that's a good question. So that's another, it's almost situational on what our appetite is. If you ask me, because I just did one for a brewery, it was about $1.2 million for the construction project. That was approved 12 months ago. They're finishing up now. If you asked us to do that now, I'd probably tell you we aren't going to do that right now, because the problem there is construction, and a lot of times is speculative. Mm-hmm. So, like I said, if there's no concrete evidence that, hey, this is going to produce income, or already is in some capacity, we just need more space to, if you're outgrowing your current model and you're saying, hey, I need more space, then construction makes sense, right? The add-on makes sense. Or if you're in a great area of town and you're saying, hey, I want to add 8 units to my existing unit, and I have, and it will cash flow greatly if I can add more units, then yes, of course. But to say, hey, I want to build office space right now, or I want to build a restaurant right now, it's really tough to say, hey, yeah, that's something we're really having an appetite for, because I don't really think that we do right now.
For sure. And then we had another question related to property cost, but probably related to really just based on the transactions. And
Yeah.
that's another thing that in general, properties, it's dependent on what the market's willing to pay for. So if you think about it, if banks are not necessarily lending as much, then there may not be as many transactions, in which case the sellers may have to accept a lower price for their property, or they sit on it for a long period of time. So the question was, does property cost, has it gone up or is it going down because of this whole situation? So,
That's really tough to gauge right now. I would assume, I've seen drops in price across the board right now, but they haven't been significant yet. They've been really small, I guess, because people are assuming that it is, and rightfully so. But no, I haven't seen it yet. I haven't seen an appraisal since all this happened. I haven't seen an income-based appraisal since COVID-19 started. So what that means, and Raphael, you probably know this, there's value-based appraisals and then there's income-based appraisals. And if it's for investment property, multifamily, you're generally always going to get an income-based appraisal rather than a value-only appraisal. So for those who in here who are looking to say, hey, I'm new to investing, a value base is going to be, I've got multiple units. It's valued based on how much money this brings in on a yearly basis. Whereas a value only is saying, hey, we're going to use comps for this, what's selling in the area. You're going to see that on single family properties, generally speaking.
definitely. So Nick Grisanti is asking, on commercial investments with no owner user components, are your underwriters analyzing the tenant mix for COVID-19 resiliency? So
Sorry, you cut out.
I think what he was asking is that on commercial investments, if let's say it's a non-owner occupied user, so let's say you're buying a strip center and you're looking at the business within that strip center to say, hey, are they resilient versus within this environment we find ourselves in? So I'm assuming like a lot of retail businesses such as hair salons and other retail businesses are shut down right now. So they're not producing any income. So if you were to analyze a deal, and especially going forward, this may be kind of an interesting thing to think about, is how do you think the bank's going to be looking at those businesses?
Yeah.
So.
No, that's a good question. So there's been two resources, at least we as Republic Bank have been offering. So there's a three-part answer to your question. One is the owner of that property taking deferrals if they have a mortgage? Republic Bank was offering, people that were struggling or saying, hey, we have tenants that can't pay right now, and rightfully so. That makes sense. So we were saying, hey, if you're in a situation like that, let's look at a deferral for you. Let's say, hey, a deferral makes sense for you. Don't pay. Let's say don't pay your mortgage for 90 days. Do you allow your tenants not to pay for 90 days as well to match what you're looking at? So the tenants in turn aren't making their payments, but the operating cost for the business is taking a deferral. So that doesn't count as an operating cost for them. And if you write it down, if we go in 2021 and someone's trying to buy something or refinance something, we're going to look at 2020 as an outlier, right? I mean, it's an anomaly that they may not produce income for those 3 months. I think an underwriter would look at that. They would take into consideration and say, hey, that was an anomaly. This isn't something that happens every single year. And say, hey, yeah, we can add that back into cash flow. That's how I would see it. But that we're not going to see those numbers until next year, right? So we're not going to ask for 2020 financials in 2020. So to answer your question is, the owner of the property is taking a deferral. The tenants don't have to pay. The highest operating cost a tenant has is generally going to be employment. So what did the tenant do to help with employment? They took a PPP loan. So what happens is you have a 3-part process where no one's really making payments because no one has the debt, doesn't have any debt to service. So how an underwriter looks at that is almost as a wash when they go to see financials for 2020. You guys there?
Yeah, sorry, I was muted.
Oh,
but
sorry.
as far as tenant mix goes, do you guys put consideration into what type of businesses are in this location?
Yeah, we do. I mean, we understand restaurants are high risk. Restaurants are high risk. What else is there? If you see a dry cleaner in there, I don't know if what's the first thing that pops into your head when you see a dry cleaner?
environmental.
Yeah, exactly. And you know, you got to see how that place works. The nice thing about them is they're usually performing well, generally speaking. But restaurants is the one thing to look at. If you have a strip center full of just restaurants only, and let's say, you know, and we can ask you guys, or we can ask the owner of the place to say, hey, how are they performing? That might be a good question to ask as the owner of a building, or someone who's looking to purchase a building. Hey, what's the performance look like for each of your tenants?
Sure. All right. So anyone have any other questions as far as the commercial underwriting process? And you can ask them anything. If you're a business owner looking to buy a building, or if you're an investor looking to kind of figure out ways for you to finance your next investment project. I mean, Nick is obviously an expert in that, so he'd be happy to answer any questions you have.
Yeah, definitely.
We'll give it one more minute or so. If there's no other questions, we'll kind of wrap it up. And
feel free to give everyone my email as well. You know, people think things afterwards. And again, I can't stress this enough. Commercial property is so unique every time. That's why I said it's so different. You know, to answer a question to say that every situation is the same and that we would approve it or not approve it in every situation is really tough, because, you know, it's different every time. So.
Cool. Well, okay. I guess we'll go ahead and wrap it up. And first off, I just want to thank you, Nick, for stopping by and providing as much information as you did. I mean, I'm sure a lot of us got a ton out of it. Like I said, we do record this, so it will be available to see on YouTube, and we're live on Facebook right now. So hello to everyone on Facebook who's watching. And yeah, I guess we'll look forward to seeing you guys soon.
Yeah, definitely. Shoot that email out. Don't hesitate. I don't mind it at all. And feel free to put my phone number in there too, okay?
Yeah, I will.
Awesome.
All right, guys. Thanks. Good talking to you guys.
I appreciate you. Bye.
All right, bye.